Subscribe to our YouTube channel and press the bell icon to get the latest updates.
Hello everyone, Rahul Shah here, trying to make investing accessible and profitable for the average investor. I'm a big fan of Mark Spitznagel. I hope I'm getting his last name right. Now, Mark Spitznagel is one of the most unconventional investors I have come across. Mark runs a hedge fund called Universa Investments. Mark's approach to investing is unlike any I have seen before. You see, you and I make our investments with the knowledge that we will see years of steady returns, and then there will be this 1 year where there will be a big loss. A typical market cycle where you have a few years of bull market and then one or a couple of years of bear market where there are big losses. And we happily accept this. We are used to the idea of making steady returns and then witness the odd huge loss. Mark Spitznagel, on the other hand, is fine with making small losses every year if that allows him one highly profitable year every few years. His approach is diametrically opposite to our approach. We make steady returns and suffer one big loss every few years. Mark makes small losses and makes one big return every few years. So he will lose 1% to 2% of the portfolio every year and then suddenly make 4,000% returns in just one quarter. Wait, did I say a gain of a massive 4,000%? Yes, that's right. In early 2020, when markets were crashing around the world on account of the coronavirus pandemic, Mark and his investors were laughing all the way to the bank. His fund returned a staggering 4,144% in the first quarter of 2020. Now, how exactly does he do this? Well, apparently his fund uses options to construct a portfolio of this kind. But what he uses is not important. The underlying philosophy is more important. I quite like the idea of being unconventional and making small losses each year, followed by one big year which will wash away all your previous sins. I'd be more than happy to lose 1% to 2% of my portfolio every year if I earn a massive 4,000% gains in 1 year alone. If you want to know more about Mark and his strategy, I'm sure you know how to do it. Just Google his name and you will have all the information you need. But this video is not about Mark's unconventional approach to investing. It is about another of his ideas, which is in a way closely related to his first idea. Now, in an article that he wrote few years back, Mark argued that we are living through truly unprecedented risky times for investors. He opined that global markets have never been more distorted by central bank manipulations than they are today. Investors can only hope that such manipulations don't end up in yet another catastrophic loss. In short, Mark is worried that sometime in the near future, there is going to be a massive crash in the stock market. Well, as far as the Indian stock market is concerned, the last time such a big crash happened was in the year 2008. The Sensex fell by a massive 52% during the year. Please note that this is the Sensex I am talking about, an index of the largest companies in India. The smaller companies were even worse off, a lot of them eroding 70%, 80%, even 90% of their market value in 1 year flat. It was one of the darkest periods in the Indian stock market history. Well, during this entire dance of wealth destruction, there was one asset class that stood tall. Forget going down, this asset class actually recorded a gain of an impressive 29%. Yes, you heard that right. In the middle of the stock market ruin, this asset class stood rock solid and notched up 29% returns. Well, this asset class is none other than the yellow metal gold. It was gold that investors flocked to during one of the worst financial crises since the Great Depression. In fact, if you look at this table, gold has made a habit of going up whenever the stock market has crashed. There have been 6 calendar years since 1990 where the Sensex has lost 15% or more in a single year, and gold has gone up an average 14% in each of these years. In fact, gold has even beaten the FD rate of interest, which on an average has returned almost 10% during these 6 years. Thus, it looks like the humble yellow metal is the hot favorite to protect your capital against a big stock market crash. Now, this is something that even Mark Spitznagel agrees with. Mark is of the view that every portfolio should have a safe haven investment to protect against a market crash like 2008. And the best safe haven, as per Mark, is the one that goes up the most in a crash year and does not prove to be a drag on the portfolio in non-crash years. Let's understand this point better with the help of this table. Cash in the bank is of course one of the safe havens. However, the problem with cash in the bank is that it provides below average returns in both a crash year as well as a non-crash year. When I say average returns, I mean the returns that you earn from fixed deposits. So cash in the bank certainly earns lower than a fixed deposit. What about dividend paying stocks? Well, dividend paying stocks do provide good returns during non-crash years, but in a crash year, they also suffer a decline like the other stocks. Of course, the decline is less than a non-dividend paying stock, but this does not amount to protecting one's capital. Then comes fixed deposits. Well, they have provided decent protection historically when the FD rates were in high single digits and even low double digits. But with interest rates falling continuously and no visibility of the rates going back up to 9% or 10%, this asset class has turned into a poor choice as a safe haven asset class. This leaves us with gold, which I think has performed the best of the lot. As we saw earlier, gold's performance during crash years has been quite good, yielding an average return of 14%. But what about the non-crash years? Well, as can be seen, its performance during non-crash years hasn't been bad either, giving an average return of 10% per year. Thus, if you're thinking of protecting your equity capital from a big stock market crash, your best bet seems to be the yellow metal gold. So gold is not only a good hedge against inflation, historical data suggests that it can also act as a good safe haven investment that protects your equity capital against a big market crash. Now the question is, how much gold should one have in one's portfolio? Well, if you've liked the performance of the Sensex plus gold portfolio in this chart, then here's what you should do. Every year you take a look at the Sensex PE multiple, and if it is more than 22 times, then you have 60% of your portfolio in gold and only 40% in stocks. However, if the PE multiple is less than 22 times, then 90% in stocks and only 10% in gold. You rebalance once every year, that is at the end of the year. This strategy would have multiplied your money by 21 times as opposed to almost 12 times returns given by the Sensex. Therefore, gold has not only proven to be a great safe haven asset, it has also helped the strategy earn market-beating returns. So here are the rules of the strategy again. If Sensex PE more than 22 times, then 60% can stay in gold. If PE less than 22 times, then only 10%. Now the reason I took 22 PE as the cutoff is because historically the Sensex has come under selling pressure at a PE of 22 times or higher. This is also closer to its long-term average. Therefore, because of these reasons, we took that as the cutoff. Okay, so the key takeaway from this is that gold can prove to be a good complement to the Sensex, provided you want to insure your portfolio against a big stock market crash. However, for the strategy to succeed, gold has to behave in a similar manner in the future like it has done in the past. The Sensex has to show a tendency to fall once it reaches beyond 22 PE multiple. If it stays there for a few years and does not correct, then gold could prove to be a drag on the portfolio. Therefore, these are the major assumptions that need to work in order for the strategy to continue outperforming. If you ask me, I think this is a low risk approach to beating the stock market from a long-term perspective and should be tried out. But please do not consider this as a recommendation. Do consult your advisor or do your own research before taking any such decision. On that note, it is goodbye from me, and I'll see you again in the next session. Bye and take care.